Join our Telegram channel to stay up to date on breaking news coverage. Bitcoin mining companies are increasingly selling equity, one of the least appealing ways to raise funds as profits dry up and borrowing becomes more expensive due to higher interest rates. In July, Core Scientific Incorporated, one of the largest publicly traded Bitcoin miners in the United States, entered into a $100 million common stock purchase agreement with B. Riley Principal Capital II. Energy Ltd, an Australian miner, announced in September that it had agreed to sell up to $100 million in equity to the same investment bank. During the crypto bull run, when investors expected Bitcoin prices to rise and publicly traded miners were seen as an efficient way to invest in the sector, these firms rushed to the equity market to raise money. Mining companies that attempt to issue new shares in order to weather the ongoing digital asset slump risk upsetting their shareholders, whose stakes are diluted. Several large miners' stock prices have already fallen this year, with Core Scientific and the US-traded shares of Iris Energy and Argo Blockchain falling by at least 78% year-to-date. Since its inception in February, the $2.35 million Valkyrie Bitcoin Miners ETF, ticker WGMI, which tracks several major public miners, has fallen 73%. Another option is to fire-sell assets, which can be equally or more damaging to shareholders. Valkyrie Bitcoin Miners ETF, $2.35 million, tracks several major public miners. Core Scientific, for example, sold about 85% of its Bitcoin reserves since the end of March. Its September update indicates the firm had $29.5 million in cash at the end of September, down 77% from $128.5 million at the end of the second quarter. The second quarter figure does not include $11.9 million in restricted cash. A recent surge in mining difficulty, a measure of Bitcoin miners' computing power, delivers another blow to companies looking to ride out the current slump. A higher level of computing power will lead to lower mining revenue for already bruised Bitcoin miners. And the more mining power there is, the less each Bitcoin miner receives. But firms that took massive loans backed by the value of their mining machines are feeling the squeeze as prices of some of these popular rigs have plunged more than 80% since last November, when Bitcoin hit a record high of $69,000, Luxor's Vera said. This also poses a major risk to their financiers, who are already under pressure with Bitcoin lingering around $20,000 since June. Lenders, including Celsius Network Limited and Asia-based Babel Finance, are grappling with liquidity issues exacerbated by the crypto market crash earlier this year. Several miners are still turning to equity financing because some lenders have raised interest rates, said Matthew Kimmel, digital asset analyst at crypto research firm CoinShares. To be sure, not all miners raising money from the equity market are flailing. Thanks for watching. Please subscribe.